Hello and welcome back to another video. Luis from TradeOptionsWithMe.com here. In this video you will learn everything you need to know about how dividends work. So first of all, what are dividends? Well, at the end of a certain time period, a company either has managed to generate a profit or it has not managed to generate a profit. If it has managed to generate a profit, it has basically two options. The first choice would be to reinvest the profits back into the business or just keep them as reserves for later. And the second option would be to redistribute these profits amongst its shareholders. The latter option is also known as paying dividends. This means if you are an investor of a company that pays out cash dividends, you will receive a certain cut of its profits. Note, however, that the company has this choice. This means it does not have to pay out dividends. Because of this, not all companies pay out dividends. In fact, in 2018, out of the about 500 companies in the S&P 500, almost 20% did not pay out any dividends. As you now hopefully know what dividends are, let me explain you how dividends work. There are 4 important dates that you have to know when it comes to investing in dividend-paying stocks. The first date is the announcement date. This is the date on which the company announces that it will pay out dividends. During the time in between the announcement date and the next date, which is the ex-dividend date, the stock price tends to increase by about the amount of the dividend. This is the case because investors are willing to pay a premium to receive the dividends. Like I just said, the next major date is the ex-dividend date. This usually is a few days after the announcement date, and it is on this date that the stock price drops by the amount of the dividend. Furthermore, if you buy the stock on or after the ex-dividend date, you will not receive any dividends. This means if you want to receive dividends, you have to buy the stock before the ex-dividend date. The reason why the stock price drops by the amount of the dividend on the ex-dividend date is, on the one hand, to prevent arbitrage opportunities, and on the other hand, because theoretically the company is worth less than it was before paying dividends, because it gave away parts of its profit. The next date is called the record date. If you sell before the record date, you will not receive any dividends either. This means you have to be long the stock between the ex-dividend date and the record date to be able to receive dividends. Note that if you are short the stock in this time, you won't only not receive any dividends, you will actually have to pay dividends. So make sure to be careful when shorting stocks that pay out dividends in the near future. The final date is called the payment date, and this is the date on which you will receive the dividends. So if you sell your long stock position before the payment date but after the record date, you will still receive the dividends. Usually the announcement date and the payment date are only a few days apart, but the exact time frame can vary from stock to stock. Now that you know how dividends work and what dividends are, let me explain the different types of dividends that exist. The first and most common dividend type is cash dividends. When a company pays cash dividends, it simply distributes its profits to its shareholders in the form of cash. The amount is usually expressed in a per share basis. So this means if a company declares a dividend of the size of 50 cents per share, this would mean that you will receive 50 cents for every share that you own in this company. So the more shares you own, the more money you will receive. Another type of dividend is known as stock dividends. Stock dividends aren't nearly as common as cash dividends, but they still exist. When a company declares stock dividends, it issues new shares of stock and distributes these among its current shareholders. For instance, if a company declares a 1% stock dividend, you will receive 1 additional share for every 100 shares that you already own. but note that the stock price will be adjusted downward accordingly. This means that there will be dilution if a company declares stock dividends. In essence, stock dividends are the same as very small stock splits. One reason why a company might pay stock dividends instead of cash dividends is when it does not have the cash available, or if it didn't manage to generate a profit in the time frame. The dividend payment frequency can vary from stock to stock. The most common dividend frequency is quarterly, but some companies also only pay out dividends on a semi-annual or annual basis. Other stocks pay out dividends even less frequently. But generally speaking, companies do not change their dividend payment frequency very often. Next up, let me compare common versus preferred dividends. Many companies have more than one type of share class. The most common or normal share class is also referred to as common stock. But some companies have special, usually less liquid shares that are also known as preference shares. Often preference shareholders have some distinct advantages over normal shareholders, especially when it comes to dividends. For example, the size of the dividend of common stockholders depends on the size of the profit of the company in the current time frame. However, often the size of the dividend for preferred shareholders is fixed. This can be seen as a disadvantage or advantage depending on the size of the fixed dividend versus the current dividend for common stockholders. Next up, the dividend payment frequency could theoretically vary for common shareholders. This is not always the case for preferred shareholders. Often the dividend payment frequency for preference shares is fixed. So even if a company does not manage to generate a profit in a certain time frame, preferred shareholders may still have the right to receive dividends. Furthermore, preference shareholders often have dividend priority. This means if the cash is limited, preferred shareholders receive the dividends before the common stock shareholders. With that being said, like I said earlier, not all companies have preference shares available, and even those that do, don't always offer them to the normal public. Furthermore, the normal share class common stock is much more liquid than the preference shares. The different advantages and disadvantages of preference shares versus common shares depends on the specific preference shares of a certain company. Next up, let me explain the dividend's effect on options. As the stock price is adjusted as a part of the dividend payment process, option prices are also affected. Due to the downward adjustment on the ex-dividend date, call premiums tend to be lower just before the ex-dividend date, and put premiums tend to be higher right before the ex-dividend date. In addition to that, the assignment risk for short option positions, especially for short calls, increases dramatically leading up to the ex-dividend date. This is the case because many option traders exercise their options right before the ex-dividend date so that they will receive the dividends. This is the case because you have to own shares of the stock to receive dividends. If you only own options, you won't receive any dividends. Last but not least, let me present to you which stocks you should buy for dividends. Note that what I'm going to present next are just some general guidelines. I'm not going to name any specific stocks that you should buy. I'm just giving you some guidelines that I would recommend using when looking for dividend stocks to invest in. First of all, make sure that the company even pays dividends. If it does not pay dividends, then there's no point in investing in the stock for dividends. Furthermore, aim for consistently profitable companies. Hopefully by now you understand that dividends, and especially the size of the dividends, are heavily correlated to the profitability of a company. If a company does not manage to generate profit, on a consistent basis, then it likely won't pay out dividends on a consistent basis. The third tip is avoid volatility and seek stability. As a dividend investor, your main goal is to invest for cash flow and not to invest for growth. This means you should not aim for very speculative, highly volatile companies. Instead, focus on stable and consistently profitable companies. Next up, it's important to understand that just because the dividend yield of a certain company is the highest in 1 year, does not mean that it's a good dividend investment. Often stocks with slow and stable dividend yield growth rates can be much better than stocks with the highest dividend yield in 1 year. Always remember that the cash dividends are paid by a company's profit, so if a company pays out very high dividends, this might negatively impact the company's future. Besides that, you should also consider the overall market. Remember that most stocks follow the overall market. So if the overall market is crashing, you should probably not buy dividend stocks to receive dividends. Last but not least, make sure to buy before the ex-dividend date. If you don't do so, you won't receive the next dividend. I really hope you enjoyed this video and learned something new. If you have any questions or comments, please make sure to let me know in the comment section below. I will do my best to help you out as fast as possible. With that being said, thanks so much for watching. I truly hope you enjoyed this video. Make sure to subscribe for more content like this. See you in the next video.